Nearly 2,000 American banks are at risk of failure between 2026 and 2027. Not 20, not 200, nearly 2,000. Florida Atlantic University published an update to its U.S. Banks' exposure to risk from commercial real estate screener, and the results revealed a significant deterioration in the balance sheets of banks exposed to commercial real estate lending. Among the approximately 5,000 banks operating in the United States, 1,788 have total commercial real estate exposures greater than 300% of their total equity capital. That means the loans these banks have made on office buildings, shopping malls, warehouses, apartment complexes, and retail centers are worth more than 3 times the total capital cushion the bank holds to absorb losses. And 77 of those banks have exposures greater than 400%, and 504 have exposures greater than 500%, and 216 have exposures greater than 600% of their total equity capital. And every single one of those categories increased from the prior quarter. The crisis is not stable. It is accelerating. And a separate academic study estimated that around 1/3 of all commercial real estate loans and the majority of office-related loans may face significant cash flow problems and refinancing challenges. If you apply a 33% non-performing loan ratio to banks with CRE exposures above 300% of equity, the math produces insolvency. The equity is wiped out, the bank fails, and there are 1,788 banks in that category. And the first one already failed this year. On a Friday night in February, Illinois regulators quietly closed Metropolitan Capital Bank and Trust, transferring deposits through the FDIC in what was officially described as a routine resolution. The bank had assets of around $261 million. The FDIC confirmed it was the first U.S. bank failure of 2026, with an estimated loss of $19.7 million to the Deposit Insurance Fund. And the timing was significant. The closure occurred on the same day that global markets were hit hard, with gold and silver experiencing some of their steepest daily declines in decades in moves that resembled forced selling rather than normal correction. The characteristic pattern was high leverage and waves of margin calls cascading across asset classes simultaneously. IDN Financials reported that over the following 24 hours, markets that remained open moved violently with almost no pause for adjustment, reinforcing the impression that liquidity stress was spreading across asset classes. A clean FDIC resolution does not erase the underlying message. In a high-interest rate environment, some banks remain fragile, and stress often appears first at the edges of the system. Small bank failures rarely trigger contagion on their own, but they act as early indicators, and 1,787 banks with the same structural vulnerability are still standing behind it in line. $50 billion in commercial real estate loans mature every month, and most of them cannot be refinanced. Commercial real estate operates on a refinancing cycle that most Americans have never thought about because it does not directly touch their lives until it does. Unlike residential mortgages, which are typically 15 or 30-year fixed-rate loans, commercial real estate loans are typically 5 to 10-year terms with balloon payments at maturity. When the loan matures, the building owner must either pay off the remaining balance or refinance into a new loan at whatever interest rate is available at that time. Between 2015 and 2021, CRE loans were originated at interest rates between 3 and 4.5%. Those loans are now maturing into a rate environment where commercial mortgage rates are 7 to 9%. The monthly payment on a $10 million office building loan at 4% is approximately $48,000. The monthly payment on that same loan refinanced at 8% is approximately $73,000. That is a 52% increase in the debt service cost for a building whose rental income has, in many cases, declined since the loan was originated because remote work emptied 20 to 40% of office space in most major American cities. The building owner is being asked to pay 52% more on a property that is earning 30% less. The math does not work. And when the math does not work, the borrower defaults. And when the borrower defaults, the bank that holds the loan takes the loss. And when enough borrowers default, the bank's equity is consumed by the losses and the bank fails. The Mortgage Bankers Association estimates that approximately $600 billion in commercial real estate loans matured in 2025, and a comparable volume is expected in 2026. That is roughly $50 billion per month in loans that need to be refinanced or paid off. Each one of those maturities is a decision point where the property owner either accepts the dramatically higher rate, sells the property at a loss, or hands the keys back to the bank. Industry data suggests that delinquency rates on CMBS office loans have climbed above 10% nationally and exceed 15% in markets like San Francisco, Los Angeles, and Manhattan. And the properties that are being handed back to banks are not worth what the loans say they are worth. Appraisals from 2019 and 2020, when the loans were originated, valued office towers at prices that assume 95% occupancy and pre-pandemic rental rates. Current market values for the same buildings are 30 to 50% lower. The bank that takes the building back in foreclosure does not receive an asset that covers its loan. It receives an asset that is worth half the outstanding balance. The loss is the bank's, and the loss is coming out of the same equity capital that was supposed to protect depositors. And the office sector is only the most visible face of the commercial real estate crisis. Retail properties are under pressure as e-commerce continues to take market share from brick-and-mortar stores. Multi-family apartment buildings that were financed at 3% cap rates during the 2021 boom are now valued at 5 to 6% cap rates, which means the same building is worth 30 to 40% less than the loan balance even if it is fully occupied. Hotels that were financed based on 2019 revenue projections are underperforming those projections in markets where business travel has permanently declined. And senior living facilities, which represent a growing share of CRE lending, are facing occupancy challenges and staffing costs that make their revenue projections from loan origination unrealistic. The commercial real estate crisis is not an office crisis. It is a rolling wave of refinancing failures that will hit every property type over the next 24 months as loans originated during the low-rate era mature into a rate environment that makes the original financing terms impossible to replicate. And the banks that hold these loans cannot sell them without recognizing the losses. As long as the loans are on the books at face value, the bank's balance sheet looks solvent. The moment the bank marks the loan to market value or the borrower defaults, the loss materializes and the equity absorbs it. This is why the FDIC's problem bank list understates the real number of vulnerable institutions. The problem bank list captures banks that have already deteriorated to the point where regulators have flagged them. It does not capture the hundreds of banks that are carrying unrealized CRE losses that have not yet triggered a regulatory flag, but that would become visible in any honest stress test. And the stress tests, as I mentioned, are being made easier, not harder. Silicon Valley Bank was not an anomaly, and Stanford proved it with math that should terrify every depositor in America. Stanford's Institute for Economic Policy Research published a study titled Fragile: Why More U.S. Banks Are at Risk of a Run, that should have ended the narrative that the 2023 bank failures were isolated incidents involving uniquely mismanaged institutions. Stanford's researchers examined the entire U.S. banking system and concluded that recent declines in bank asset values, especially in commercial real estate, have significantly increased the fragility of the U.S. banking system to uninsured depositor runs. Their analysis focused on a concept called uninsured leverage, which is the ratio of uninsured liabilities to total assets. When a bank's assets decline in market value below their book value, there is a discrepancy between what the bank says it owns and what it actually owns. And that discrepancy means that in the case of a run, the liquidation value of assets would not be sufficient to cover both insured and uninsured deposits. That finding applies not to one bank. It applies to a structural pattern across the entire U.S. banking system. And the study found that regions with lower household incomes and large shares of minorities are more exposed to this bank risk. Counties with median annual income below $35,000 are disproportionately served by banks at risk, with about 4% of deposits at risk of impairment. The communities least equipped to absorb a banking disruption are the communities most likely to face one, and the events that followed the study's publication validated its methodology. Silicon Valley Bank failed on March 10, 2023 with $209 billion in assets. Signature Bank was closed 2 days later. First Republic Bank was seized on May 1, 2023 and sold to JP Morgan Chase. All three banks had the exact characteristics Stanford identified as risk factors: significant declines in asset values and high shares of uninsured deposits. And the FDIC's own review of the failures confirmed that had Silicon Valley Bank been required to include unrealized losses on its available-for-sale securities in regulatory capital, the bank might have averted the loss of market confidence and the liquidity run. The vulnerability was known. The regulatory fix was proposed. And 3 years later, the fix has not been fully implemented. The banks with the same structural vulnerabilities are still operating with the same unresolved risk, and the unrealized losses on bank balance sheets have not disappeared. The FDIC continues to monitor unrealized losses on securities portfolios across the banking system. Although the figures have improved somewhat from their peak in late 2023, the losses remain large enough to strain the balance sheets of weaker banks, especially while funding costs stay elevated. When interest rates rose from near zero to above 5% between 2022 and 2023, the market value of long-term bonds and mortgage-backed securities held by banks plummeted. Banks that held these securities at face value on their books were carrying assets worth significantly less than their stated value. Silicon Valley Bank's collapse was triggered when it sold $21 billion in securities at a $1.8 billion loss, revealing the gap between book value and market value that spooked depositors and triggered the run. The same gap exists at hundreds of other banks today. The difference is that those banks have not yet been forced to sell their underwater securities. They are holding them to maturity, which allows them to carry the securities at book value rather than market value on their balance sheets. That accounting treatment is perfectly legal, and it is also perfectly misleading. Because if those banks were forced to sell those securities today to meet deposit withdrawals, to cover loan losses, or to raise capital, they would realize the same losses that destroyed Silicon Valley Bank. The FDIC estimated that unrealized losses across the banking system exceeded $500 billion at their peak. They have improved as rates stabilized but remain in the hundreds of billions of dollars. And every bank that is carrying significant unrealized losses is one bad quarter, one deposit outflow, or one CRE loan default away from being forced to recognize those losses. And recognition is the event that triggers the run. 7 of America's 10 largest banks have dangerous commercial real estate exposure, and nobody is talking about it. Most financial media coverage of the CRE crisis frames it as a small bank problem. Community banks, regional lenders, institutions that most Americans have never heard of. Florida Atlantic University's data destroys that narrative. Among the 10 largest U.S. banks, 7 have total commercial real estate exposures greater than 50% of their total equity capital. U.S. Bank, one of the largest financial institutions in the country, carries CRE exposure of 77% of total equity. And many banks with total assets between $50 billion and $100 billion have exposure ranging from 350 to 500% of equity. Flagstar Bank, the rebranded name of NYCB, which nearly collapsed in early 2024 after disclosing massive CRE losses, is among them. And in May 2025, Moody's downgraded the long-term credit ratings of JP Morgan Chase, Bank of America, and Wells Fargo. Not because of CRE specifically, because the U.S. sovereign credit downgrade made the Treasury securities those banks hold as safety assets slightly less safe, which made the banks themselves slightly riskier. Stack the sovereign downgrade on top of the CRE exposure, on top of the unrealized securities losses, on top of the elevated funding costs, on top of the Iran war oil shock, and the combined balance sheet pressure on American banks in 2026 is unlike anything seen since 2008. And the Fed recently announced easier and less conservative assumptions for CRE in its 2025 stress tests. Read that sentence again. At the exact moment when CRE risk is accelerating, the regulator responsible for testing whether banks can survive it is making the test easier. Safer banking. Research warned that the stress test assumptions are so lenient that they may fail to detect the very failures they are designed to prevent. If the test assumes a 10% decline in CRE values and the actual decline is 35%, the test is not a test. It is a permission slip for banks to continue operating with risks that would fail any honest assessment. When a bank closes, you do not get your money back immediately, and most Americans have no idea what the process actually looks like. Most Americans believe that bank failures are seamless events where the FDIC steps in, covers your deposits, and everything continues without interruption. That belief is partially true and dangerously incomplete. Here's what actually happens when a bank closes. The FDIC typically announces the closure on a Friday evening after markets close. This is deliberate. It prevents a bank run during business hours and gives the FDIC the weekend to arrange a resolution. If a purchasing bank is found, your deposits are transferred to the new institution and you may have access by Monday or Tuesday. If no purchasing bank is found, the FDIC issues checks to insured depositors, which can take days to weeks. During that period, you cannot access your money. Your direct deposits, your automatic bill payments, your mortgage autopay, your rent, your utility payments, your credit card payments are all disrupted. If you have more than $250,000 at the failed bank, the amount above $250,000 is not guaranteed. You become an unsecured creditor of the failed bank and may recover pennies on the dollar or nothing at all, depending on the bank's asset recovery. The FDIC insurance limit has been $250,000 per depositor per institution since 2010. In real inflation-adjusted dollars, that $250,000 is worth approximately $172,000 in 2010 purchasing power. Your protection has shrunk by 31% without Congress ever voting to reduce it. And the disruption extends far beyond temporary loss of checking account access. If you run a small business and your payroll account is at the failed bank, you cannot make payroll. Your employees do not get paid. If your mortgage auto-drafts from that bank, the payment bounces. If your Social Security direct deposit goes there, your benefit is delayed until the FDIC arranges the transfer. During the 2008 crisis, businesses with credit facilities at failed banks found their lines frozen overnight, cutting off working capital for inventory and payroll. And when Silicon Valley Bank failed in 2023, deposit outflows accelerated at dozens of regional banks across the country. First Republic lost nearly half of its uninsured deposits in weeks. Pacific Western Bank stock collapsed. The KBW Regional Banking Index fell more than 40% between March and May 2023. A single failure created a confidence crisis that destabilized the entire regional banking sector for months. And Safer Banking Research has warned that the banking industry's desired move toward bail-ins, where losses are absorbed by depositors and creditors rather than by taxpayer-funded bailouts, means that uninsured depositors may face actual haircuts in future bank resolutions. During the Cyprus banking crisis of 2013, uninsured depositors at the two largest banks lost 47.5% of their deposits above the insurance threshold. That was a European Union member state, with modern banking infrastructure, with deposit insurance, and nearly half of the uninsured deposits were confiscated to recapitalize the banks. Bail-in is not a theoretical framework. It is an implemented policy in multiple jurisdictions, and it is the direction that global banking regulation has been moving since the 2008 crisis. The Dodd-Frank Act's Resolution Authority explicitly shifted the U.S. framework away from bailouts and toward bail-ins, meaning wholesale depositors cannot assume they sit outside the loss-absorbing perimeter. Branch closures are accelerating and entire communities are being cut off from their own money. Beyond the catastrophic scenario of bank failure, there is a quieter crisis unfolding across America that is already affecting millions of households. Banks are closing physical branches at an accelerating rate. Santander closed 18 branches in New England by August 2025. U.S. Bank announced the closure of 7 branches in eastern Idaho by June 2025. Citizens Bank closed 14 branches in the Northeast in October 2025. These are not isolated decisions. They are part of a systematic withdrawal of physical banking infrastructure from communities that depend on it. Since 2017, more than 6,000 bank branches have closed across the United States. The closures disproportionately affect rural communities, low-income neighborhoods, and elderly populations who are less likely to use mobile banking and more dependent on in-person services for cash deposits, check cashing, loan applications, and account management. When a bank branch closes in a small town, the nearest alternative may be 30 or 40 miles away. For a retiree without reliable transportation, for a small business owner who needs to deposit cash daily, for a family that does not have broadband internet access, the branch closure is not an inconvenience. It is a severance from the financial system. And the communities that lose their branches are the same communities that Stanford identified as most exposed to bank failure risk: low-income, rural, minority-concentrated areas where the remaining banks carry elevated CRE exposure and depressed asset values. The financial system is simultaneously becoming more fragile and less accessible. The banks that remain are weaker. The branches that serve the most vulnerable populations are closing, and the FDIC insurance that is supposed to protect depositors has not been adjusted for inflation in 16 years. The combination of these three trends, weakening banks, disappearing branches, and eroding insurance protection, is creating a banking environment that is less safe, less accessible, and less reliable than at any point since the creation of the modern deposit insurance system in 1933. And banks are also closing customer accounts with little explanation. Reports have increased of banks shutting accounts due to suspected fraudulent activity, sometimes flagging legitimate transactions as suspicious and locking customers out of their own money without warning or adequate explanation. A customer who receives notice that their account has been closed has 30 days to find a new bank, transfer all automatic payments, redirect direct deposits, and reorder checks. If they do not complete that process in time, their payments bounce, their credit score is damaged, and they may be reported to Check Systems, a banking industry database that can make it difficult to open a new account at any bank. And the consolidation of the banking industry means there are fewer banks to choose from. The number of FDIC-insured banks in the United States has declined from over 8,000 in 2000 to approximately 4,600 today. Nearly half of all American banks have disappeared in 25 years through mergers, acquisitions, and failures. Each consolidation reduces competition, reduces the number of institutions available to consumers, and concentrates more deposits in fewer banks. And the banks that survive the consolidation become larger, more complex, and harder to resolve in the event of failure. The too-big-to-fail problem that the 2008 crisis was supposed to resolve has instead been amplified by 17 years of consolidation. The largest banks are larger than they were in 2008. They hold more deposits. They have more interconnections with the broader financial system, and the regulatory framework that was supposed to prevent another crisis has been gradually weakened through lobbying, deregulation, and the kind of stress test easing that Florida Atlantic University and Safer Banking Research have documented. The guardrails have been lowered at the exact moment the road has become more dangerous. Bail-ins mean your deposits above $250,000 are no longer protected the way you think they are. Resolution regimes around the world have shifted fundamentally since 2008, and most depositors have not updated their understanding of what happens when a bank fails. Arling Close, a Treasury advisory firm, warned after the February 2026 Metropolitan Capital Bank failure that today's resolution regimes have shifted away from bailouts towards bail-ins, meaning wholesale depositors can no longer assume they sit outside the loss-absorbing perimeter. In plain English, if a bank fails and the FDIC determines that a bail-in resolution is appropriate, your deposits above the $250,000 insurance limit can be converted into equity in the failed bank or written down to absorb losses. You do not get a choice. You do not get a vote. Your money above the insurance limit is used to recapitalize the bank, or it is simply lost. The Financial Stability Board, which coordinates international financial regulation among G20 nations, has published guidelines for bail-in resolution that are designed to ensure that taxpayers never again foot the bill for bank failures. The cost is instead borne by the bank's shareholders, bondholders, and uninsured depositors, in that order. Shareholders are wiped out first, bondholders take losses second, and uninsured depositors absorb whatever remains. In the case of Silicon Valley Bank in 2023, the Treasury, Fed, and FDIC intervened with a systemic risk exception to protect all depositors, including those above $250,000. That intervention was discretionary. It was not required by law. It was a political decision made under emergency conditions to prevent contagion. There is no guarantee that the same decision would be made for the next bank failure, especially in a political environment where the national debt has been downgraded by all three rating agencies, where the FDIC's Deposit Insurance Fund has already absorbed losses from the 2023 failures, and where the political appetite for bailouts of any kind has collapsed. If you have more than $250,000 in a single bank and that bank fails, you are making a bet. You are betting that the federal government will choose to make you whole even though the law does not require it. You are betting that the political environment will support an emergency intervention. You are betting that the FDIC has sufficient resources to cover not just your bank, but all the banks that might fail in a cascading event. And you are betting that the bail-in framework that regulators have spent 15 years building will not be used in exactly the scenario it was designed for. That is a bet. And most Americans do not know they are making it. They think their deposits are guaranteed. They are guaranteed up to $250,000. Above that, they are a bet on the political willingness and fiscal capacity of a government that is running a $1 trillion annual deficit and has been downgraded by every rating agency on Earth. And here is the dimension that connects every financial stress into a single cascading risk. Higher energy costs from the Iran war are flowing into higher operating costs for commercial properties. Higher operating costs reduce net operating income. Lower income reduces appraised values. Lower values mean CRE loans held by banks are even more underwater than before the war. And the Fed cannot cut rates to provide relief because inflation is at 3.3% and rising. And the government cannot easily bail out banks because the national debt has been downgraded by all three rating agencies and interest payments already consume $1 trillion per year. The FDIC Deposit Insurance Fund held approximately $128 billion in late 2024. If 10 mid-sized banks with $5 billion in deposits each failed simultaneously, the fund would need $50 billion, consuming nearly 40% of its reserves in a single event cluster. And there are 1,788 banks with CRE exposure above 300% of equity. If even 5% fail, that is 89 banks. The FDIC fund would face stress that makes 2008 look manageable by comparison. The 571 bank failures the FDIC has recorded from 2001 through 2026 happened across 25 years. The CRE maturity wall, arriving in 2026 and 2027, compresses a comparable level of risk into a 24-month window. That concentration of risk in a concentrated timeline is what transforms individual bank failures into a systemic crisis. And the first domino has already fallen. Metropolitan Capital Bank, February 2026. Friday night. Routine resolution. $19.7 million loss to the Deposit Insurance Fund. Nobody noticed, but the 1,787 banks standing behind it in line noticed, and their depositors should notice too, because the question is not whether more banks will fail. The question is, how many, how fast, and whether the system built to handle individual failures can survive a wave of them arriving simultaneously from the same cause, at the same time, across the same 24-month window. The answer to that question will be written in the next 2 years, and the depositors who understood the risk and distributed their funds across multiple insured institutions before the wave arrived will be the depositors who kept their savings. The depositors who assumed the system would protect them automatically without action on their part will be the depositors who discover on a Saturday morning that assumptions are not insurance. Share this video with every American you know who keeps money in a bank, because the information in this video is the difference between a depositor who understands the risk and a depositor who discovers it when the FDIC letter arrives on a Saturday morning explaining that their bank closed on Friday night and that the portion of their savings above $250,000 is subject to the resolution process. Nobody should learn this from that letter. Subscribe and turn on notifications. No spin, no party line. Just the math that the banks do not want you to understand and the regulators are not explaining in language you can act on.